Welcome back to The Deep Dive, the show where we take a stack of dense, high-level analysis and turn it into actionable intelligence for you, the curious learner.
We cut through the noise, we try to bypass the jargon, and get straight to the so what of the world's most complex and, often mispriced stories.
And today, we are talking about a giant. A giant that, frankly, a lot of people thought had peaked. We're discussing Tencent Holdings.
The undisputed tech titan, the architect of, basically China's entire digital ecosystem. Ticker is 0700 on the Hong Kong Exchange.
Yeah, and if you followed their story from, say, 2021 through 2023, it was just brutal.
That was a bloodbath.
Regulatory crackdowns that wiped out hundreds of billions in value, a major economic slowdown hitting their core services, and, that vicious competitive war against rivals like ByteDance.
For a while, it really did feel like the whole Tencent machine was sputtering, kind of stuck in the mud.
But that narrative, that idea of stagnation, seems to be definitively outdated now.
It is. Our sources today, and we're looking specifically at a really comprehensive equity research report published late 2025, right after the Q3 earnings, they suggest a profound turnaround.
And they use a powerful word to describe what's happening. They're calling it a renaissance.
A renaissance, exactly.
And a renaissance implies, a rebirth, a fundamental transformation, not just some cyclical bounce.
For sure.
So as we dig into all this material, we have a massive stack of earnings reports, long-term valuation models. What's our core mission here for the next 30 minutes or so?
I think our mission is pretty clear. It's to extract the core insights from these reports, to understand why the market might still be mispricing this company, if it is.
Right, if it is.
We're going to try to move beyond the fear-based headlines and all the short-term noise, and we're going to assess Tencent using the ultimate yardstick for durable competitive advantage.
The Warren Buffett investment framework.
The one and only. We have to answer the big question. Is the lingering skepticism what the analysts are calling the China risk premium? Is that justified? Or is it masking, a once-in-a-decade value opportunity?
Using the bucket framework is perfect for this because it forces you to focus on durability, the moat, management quality, rather than just chasing, quarterly growth figures.
Mm-hmm.
And for all of you who are tracking that kind of thing, global market froth and wanting objective measures of valuation, you can now search and download the iOS app Buffett Indicator from the Apple App Store. It's a fantastic, really simple tool for getting a daily read on the general market bubble status.
And that ability to objectively assess market temperature, that's key to finding mispriced quality, which is, that's the whole point of our deep dive today.
Exactly.
The core thesis of the report, the whole reason for this Renaissance call, it really rests on a powerful tripod of structural, fundamental improvements. And you can see them clearly now in the Q3 2025 numbers.
Okay, so let's unpack that structural shift. Let's go pillar by pillar.
All right. First, you have this explosion in international gaming. This isn't just a little bit of growth. It's a critical sort of insulated growth vector that hedges Tencent against any regulatory shifts in its home market.
Okay, that makes sense. So diversification, what's number two?
Second is the deployment of advanced AI. Specifically, their Hunyuan Foundation model, which is now aggressively driving high-margin ad revenue across the entire Weixin ecosystem.
So better tech, higher quality dollars coming in the door.
Exactly. And the third pillar, which is, vital for you, the shareholder, is aggressive, highly rational capital allocation.
Okay.
And you can see this best in their unprecedented annualized share buyback program, which is now exceeding 100 billion Hong Kong dollars. It just shows management discipline and a strong belief that their own stock is undervalued.
And just to set the stage for you, the listener, we're not just going to talk about total revenue growth because that top-line number, it can be really misleading if it's low quality. The fundamental proof of this whole shift lies in one critical metric we're going to keep coming back to. Gross profit is growing significantly faster than revenue.
And that right there, that's the signal. It points to a profound, really intentional internal shift, moving away from, low-quality expansion toward genuine, high-margin, sustainable growth.
That decoupling of profit and revenue growth,
Yeah.
that's the financial signature of a company that has strategically cleaned house.
Yes, exactly.
Okay, let's dive into section one, the structural pivot from volume to value. This is where we need to understand the operational philosophy that defines this turnaround.
Mm-hmm.
So Tencent spent years defined by that mobile internet boom era, right? Growth at all costs.
Mm-hmm.
burning cash to acquire users, dominate every peripheral market. What does this new philosophy of high-quality, sustainable growth actually mean in practice?
It means a radical shift in focus. I mean, historically, if a business generated, say, 100 million RMB in revenue, but it required 95 million in costs, Tencent might still have pursued it.
Right, for market share, just to get the logo out there.
Just for market share. Today, that project is out. They are prioritizing margin over market share in all their non-core segments, and they're focusing all their vast resources on areas where they have, near monopoly pricing power.
Like the Wuxin ecosystem and their evergreen game.
Exactly.
So financially, what is the hard evidence? What's the proof of this pivot?
Well, the evidence is that definitive decoupling of profit growth from revenue expansion we just mentioned. They are actively shedding low-margin revenue streams, and we'll talk about those subsidized cloud projects in a bit, to focus exclusively on higher quality, higher margin offerings.
So it's an internal optimization program.
It is. It's aimed at maximizing returns on capital, which is, classic value investing territory.
And did the Q3 2025 headline results, did they definitively prove that this shift is working? Did it shut down that bear narrative of stagnation?
I think they absolutely did. The numbers were just definitive. Total revenues climbed to 192.9 billion RMB, which is a robust 15% year-on-year increase. That's really solid top-line growth for a company of this scale.
It is.
But here's where we need to slow down and look closely. Gross profit surged 22% year-over-year to 108.8 billion RMB.
Whoa, okay, let me repeat that for the listener, because this is the core of the whole Renaissance idea. 15% top-line growth, but a stunning 22% gross profit growth. That 7 percentage point difference is not an accident. That is the proof of the pivot. That's management successfully shedding the dead weight.
Precisely. And this margin expansion isn't cyclical. The analysts argue it's structural. When your profit grows so much faster than your revenue, it means you've fundamentally improved the mix of your business.
Right, towards those higher margin activities.
And you've achieved significant operating leverage by managing your costs of goods sold way better than before. And what's more, the efficiency drive shows up even lower down the income statement. Non-IFRS operating profit rose 18% to 72.6 billion.
And when we look at that operating profit, what does the margin itself tell us about their overall corporate efficiency?
It tells us the efficiency drive is incredibly effective and, pervasive across the company. The non-IFRS operating margin expanded to 38%.
Up from 37.
Up a full percentage point from 37% the prior year. And you have to remember, this is Tencent, a multi-trillion-dollar company. To expand your operating margin by a full percentage point at that scale, it just illustrates the raw power of the operating leverage that's inherent in their platform model.
So they're managing to squeeze significantly more core profit out of every single dollar of revenue they bring in.
They are?
That is compelling evidence that the internal cleanup is working. Yet the report insists the market still prices Tencent way below its historical averages and below global peers like Meta or Google. Which brings us back to that persistent market skepticism, the China risk premium.
And that's the billion-dollar question, isn't it? The China risk premium is this invisible discount that gets applied to Chinese tech assets because of external systemic risks. The market is nervous about three things at once.
Okay.
The lingering fear of unpredictable regulatory action, macroeconomic uncertainty within China, the property crisis, cautious consumer confidence, and then the escalating geopolitical tensions that could affect technology supply chains.
But if the regulatory environment has normalized, as the sources suggest, why is that skepticism so sticky? The PE multiple is still well below its historical mean of around 30 times.
The market has a long and very painful memory. The 2021 crackdown showed investors that the rules of the game can change, overnight.
And destroy value instantly.
So investors are essentially saying, we agree this is a high-quality, high-return business. We see the 20% ROE, but we demand a 20 to 30% discount because Beijing holds a nuclear option.
It sounds like the classic conundrum for a value investor. Finding a wonderful business that's priced as merely a good one because of these external, non-business specific risks.
That's the whole game. The report argues this disparity is a massive mispricing because the market has failed to fully recognize two things. First, the durability of Tencent's economic moat, and second, how successfully the management team has insulated critical growth vectors through international expansion.
Okay, so we need to look at those engines next.
Yeah, to truly dismantle that skepticism, we need to look at the specific segments that are proving this shift toward quality growth. So let's start with Engine 1, the gaming renaissance.
which is housed in the value-added services, or VAS, segment.
Correct.
This is their historical core business, their cash cow. In Q3 2025, how big was VAS, and what kind of growth are we looking at?
VAS delivered 95.9 billion RMB in revenue, growing 16% year-on-year.
16%.
That 16% is a significant reacceleration for a division this mature. But the key distinction here is that the growth story is split between domestic resilience and that truly stellar international explosion.
Okay, let's focus on domestic resilience first. China is a saturated, highly regulated, and very difficult market for game approvals. So how did domestic games manage to achieve 15% growth? That's 42.8 billion RMB.
This is pure strategic monetization. It's not about rapid user acquisition anymore. They are masters of lifecycle extension, what they call the games as a service, or GaaS model.
Right.
Titles like Honor of Kings and Peacekeeper Elite are so deeply entrenched that they function almost as like digital monopolies within their genres.
Let's keep them going.
Tencent continually updates the content, they offer new virtual items, and they apply these subtle monetization tweaks to keep the profitability consistent and growing, even when the regulatory environment limits new game launches. The new hits like Delta Force and Mobile Valorant, they just provided additional fuel to an already well-oiled machine.
So they're turning a classic product into a recurring revenue stream, almost like a subscription. But the true evidence of insulation from domestic risk has to be that international explosion.
Oh, absolutely. That's the diversification strategy paying off big time.
So what were the numbers?
International games revenue was the standout performer. It soared by an astonishing 43% year-on-year, reaching 20.8 billion RMB.
43%.
43. And in constant currency terms, it was 42%. That explosive, high double-digit growth in international markets, it just validates a decade-long strategic effort to acquire and empower global studios.
43% growth is massive.
Yeah.
What were the specific drivers? Was this broad-based, or did it rely on just a few specific titles?
It was concentrated but very robust. The primary drivers were a powerful resurgence in titles from Supercell, that's the Finnish studio Tencent acquired, particularly Brawl Stars. We also saw the continued, almost unstoppable performance of PUBG Mobile globally. And on top of that, the report notes a timing and revenue recognition boost from the successful launch of Dying Light, the Beast.
How does that work?
Well, because that game was sold as a copy, they recognized a significant amount of revenue upfront, which added a lot of muscle to the Q3 numbers.
This validates their whole decentralized strategy, which is often so difficult for massive Asian tech companies to pull off.
It is.
They acquire studios like Supercell or Riot Games, grant them creative autonomy, and then they quietly apply Tencent's deep, battle-tested expertise in the GaaS model monetization, anti-cheating, running live services for optimization.
It's synergistic power without the micromanagement. They let the artists create, and then they leverage their platform and their financial scale to turn global hits into these perpetual cash machines.
And this international success provides real financial insulation.
It does. It means that even if Beijing were to impose a new tax or a new regulation, a significant and rapidly growing portion of their profits is now geographically diversified. This is a critical factor that undermines that whole China risk premium argument.
That sets the perfect stage for Engine 2, the AI dividend in marketing services. The sources note they actually renamed the segment, right? Moving away from online advertising.
Yeah, to the broader marketing services. That segment delivered 36.2 billion RMB, up 21% year-on-year.
And that 21% growth is remarkable because it significantly outpaced the broader, generally sluggish Chinese digital advertising market.
It did. And this isn't market share gain through brute force. Management explicitly attributes this outperformance to deep technological integration. The key phrase here is the deployment of the Hunyuan AI Foundation model into their ad tech stack.
Okay, let's unpack that for a minute. For the listener, what is the Hunyuan AI model actually doing on a day-to-day basis that generates more money for them?
It translates directly into precision and efficiency for the advertisers. I mean, imagine a machine learning system running 24/7 that understands user behavior, preferences, and intent better than any human ever could.
Right.
The Hunyuan model enhances ad targeting precision drastically. This means Tencent can show the right ad to the right user at the optimal time.
And for the advertiser?
For the advertiser, this results in a higher effective cost per mil, or ECPM. They're willing to pay more per 1,000 views, and users click more often, which increases the click-through rates. When advertisers see a guaranteed better return on their investment, they allocate more budget to Tencent.
It's a technology-driven virtuous cycle.
It is.
And their advantage is magnified by the closed-loop nature of the Weixin ecosystem. That's something their rivals, even ByteDance, really struggle to replicate fully.
Exactly. The closed loop is the true goldmine. Advertisers can place an ad within Weixin, say in the high traffic moments feed or in video accounts, that leads directly to a transaction within a mini program.
And mini programs are those little lightweight embedded apps that live entirely inside WeChat.
Correct. And this allows for precise, transparent return on ad spend, or ROAS, attribution. Advertisers can literally see exactly how much profit their ad spend generates, which stabilizes and even increases their budget allocation. It reinforces advertiser sentiment.
Now let's talk margin impact, because this is where that structural pivot really shines. The report highlights that advertising within video accounts is a crucial source of high-quality, high-margin revenue. Why is this specific revenue stream so much more profitable than, say, the long-form video business they used to push so heavily?
It boils down entirely to the cost structure. I mean, consider legacy businesses like Tencent Video. They have to license long-form content, blockbuster dramas, movies, variety shows.
It's massive upfront costs.
Massive upfront content licensing costs and high bandwidth costs to stream terabytes of data. Video accounts, on the other hand, is primarily user-generated short-form video. It carries significantly lower, almost negligible content acquisition costs.
So their biggest expense, content acquisition, is replaced by user enthusiasm.
Precisely. Therefore, every incremental dollar of advertising revenue generated from video accounts drops almost entirely to the bottom line. It carries a far higher gross margin than any legacy media business.
Yeah.
They're leveraging their existing ubiquitous social infrastructure, Weixin, to host a new, cost-efficient advertising medium, video accounts, and they're monetizing all that attention without the previous burdensome content costs.
Okay, that brings us to Engine 3. Fintech and Business Services, or FBS. This segment showed a deceleration in growth, only 10% year over year to $58.2 billion. If everything else is accelerating, shouldn't we be a little worried about this?
Not necessarily, because this is probably the clearest evidence of the structural pivot focusing on quality.
Okay.
The deceleration is understandable on the fintech side, that's commercial payments and consumer loans, because it reflects the cautious high single-digit growth tied to the current Chinese consumer spending environment. They can't force people to spend if they're worried about the macroeconomy.
So fintech is a function of the external environment. But what about business services, which is mainly their cloud business?
So business services grew at a teens percentage rate, driven primarily by enterprise demand for AI-related cloud compute, the need for GPUs and training infrastructure. But crucially, the analysts highlight management's discipline here.
How so?
They made the strategic decision to cease pursuing low-margin, customized, infrastructure-heavy cloud integration projects.
That is the ultimate proof of the pivot in the cloud space. They stopped competing on price for these massive custom projects that looked great on the revenue line, but just dragged margins into the dirt.
Exactly. They're focusing instead on higher margin, standardized platform as a service, PaaS and software as a service, SaaS offerings, which leverage their existing infrastructure more efficiently.
So that discipline.
That discipline, focusing ruthlessly on revenue quality over revenue volume, has demonstrably lifted the segment's gross margins. It proves that the structural pivot is pervasive across the entire enterprise. It's a trade-off. Sacrifice 5% of potential growth for 10% margin expansion.
And that successful pivot hinges entirely on the durability of the platform itself. We need to move to Section 3, the wide moat, the risks, and the capital discipline.
Yeah, this is where we really understand why Tencent is a wonderful business in the language of value investing. The research report describes Tencent not as a collection of consumer products, but as a digital utility company that levies taxes. That's a stark but really powerful framing.
It is. A utility company implies essential infrastructure, and the foundation of this infrastructure is Weixin, or WeChat, which reported 1.414 billion combined monthly active users as of Q3 2025.
I mean, that's not just market penetration, it's ubiquity.
It is.
It is the essential infrastructure of modern Chinese life. It encompasses everything from social communication to payments, commerce, government services. It's more than an app. It is the operating system for how Chinese consumers live, work, and interact.
So how do the analysts define the economic moat created by this ubiquity?
The moat is derived from the classic combination of powerful network effects and sky-high switching costs.
Okay.
Network effects mean that the value you derive from Weixin increases exponentially the more of your friends, family, and businesses are also on it. And the switching costs are so high they're punitive. The report is blunt. For a user to leave WeChat today is to socially and economically isolate themselves in modern China.
That makes perfect sense. Your digital history, your contact, your payment infrastructure, your ability to interact with local commerce, it's all embedded. It's the essential toll bridge. And the report details how Tencent extracts value from this toll bridge through what it aptly calls the four taxes. Let's detail those specific income streams.
Okay, first is the virtual goods tax. This is the highest margin tax of all. Users buy virtual goods skins, digital currency, subscriptions within games, and social platforms.
And Tencent takes a cut.
A massive cut, sometimes 100% in their own games, and a 30 to 50% cut from third-party developers who need access to Tencent's massive user base. It's pure profit extraction.
Okay, tax number 2 is the transaction tax. That's powered by Weixin Pay.
Correct. Every digital transaction, from buying a coffee to paying rent, moving money to a friend, or purchasing from a mini program, generates a small processing fee for Tencent.
It's a small fee, huge volume.
Exactly. While the payment margins are thin due to regulatory constraints and bank fees, the volume is just astronomical, making it a critical source of reliable, stable income tied to the broader economy.
Third is the attention tax, what we now call marketing services.
This is the advertising we discussed. Advertisers pay Tencent for access to the highly valuable eyeballs within Moments, official accounts, and the rapidly scaling video accounts. And because that AI model, Hunyuan, is making the targeting so precise, the value of that attention, and therefore the price advertisers are willing to pay, is constantly increasing.
And finally, the infrastructure rent. This is what's powering the future.
That's Tencent Cloud and the burgeoning AI compute services. Enterprises, large and small, are paying rent for server space, data storage, and, increasingly, for the highly specialized, high-performance computing required to train and deploy their own large language models. This is the tax that's growing rapidly, driven by the current AI boom.
That is a model designed for long-term compounding. But as rational owners, we can't ignore the risks that create and sustain that persistent China risk premium.
No, we can't.
If the financial metrics are so good, why is the stock priced so conservatively? What are the most treacherous headwinds?
Well, the most obvious, the most damaging, is the regulatory overhang. While the current environment is normalized regulation, meaning the government is trying to provide stability, the market remains traumatized by past actions.
For sure.
The late 2023 crash caused by those draft rules proposing gaming spend limits is a perfect example. A single, poorly worded policy signal caused massive equity losses overnight. It just shows how quickly investor confidence can evaporate based on unpredictable government actions entirely decoupled from business fundamentals.
So the volatility is tied to Beijing, not to Pony Mao or Martin Lau.
Yeah.
What about the hard economic realities on the ground in China?
Macro dependency is huge. Two of their core segments, fintech and advertising, are highly correlated with China's GDP growth and consumer confidence. If the property crisis continues to suppress consumer spending, fintech payment volumes go down and ad budgets are immediately curtailed. The structural pivot helps mitigate this by improving margins, but they can't entirely escape the gravity of the Chinese macro cycle.
And the risk that haunts all major Chinese tech companies, the geopolitical tech war. This is where Tencent's AI ambition meets global political reality.
This is a long-term, potentially existential threat to their ability to compete at the AI frontier. U.S. export controls on high-performance GPUs, particularly chips like the NVIDIA H100s, mean their access to cutting-edge hardware is constrained compared to U.S. peers like Google, OpenAI, or Meta.
So what are they doing about it?
Well, Tencent has wisely stockpiled chips and is prioritizing them for internal training of Hunyuan, but securing consistent cutting-edge hardware access is vital for maintaining their technological moat over the next 5 to 10 years.
And finally, the perpetual battle for attention competitive intensity, specifically from ByteDance and its domestic offering, Douyin.
ByteDance remains a formidable, innovative rival, constantly battling for user time and ad dollars. But the research reports are pretty confident that Tencent's response, the successful launch and scaling of video accounts within the already impenetrable Weixin ecosystem, has successfully blunted some of ByteDance's domestic momentum.
So, not a battle they've won outright.
Not at all, but they have stabilized the front line and successfully monetized the competition.
Okay, let's pivot away from external risks to internal control. Warren Buffett places enormous importance on management quality and capital allocation. Are the leaders rational, honest, and truly aligned with outside shareholders?
The sources give them a resounding pass on rationality. The team is led by Pony Ma, the co-founder and product visionary, and Martin Lau, the strategic executor, who is particularly respected by institutional investors for his capital allocation discipline.
Let's look at the financial proof of that discipline. That massive buyback program speaks volumes about management's belief in the intrinsic value of the company.
It's the ultimate signal. In Q3 2025 alone, they repurchased 35.4 million shares for 21.1 billion Hong Kong dollars, continuing at an annualized pace exceeding 100 billion.
That's capital allocation 101.
It is. When a high-quality company is trading below its intrinsic value, which management certainly believes it is, buybacks are the most value-additive thing they can do. They are effectively retiring equity at a discount, increasing the share of the underlying business for every remaining shareholder.
It shows extreme rationality. They're avoiding that ego-driven expansion that characterized so many tech peers during the boom years.
Right.
And their unique method of distributing investee shares was pure strategic genius, wasn't it? It addressed two needs at the same time.
It was brilliant. They distributed shares of large holdings like JD.com and Meituan as special dividends. This returned billions in value directly to shareholders, often bypassing corporate tax complications for the company, and crucially, it proactively satisfied regulators who were concerned about Tencent's undue influence across the digital economy.
That shows a level of strategic execution that goes far beyond just quarterly profits. It's long-term maneuvering.
For sure. And in terms of governance, that internal cleanup provides a window into their commitment to efficiency. The dismissal of over 120 employees for fraud demonstrates a zero-tolerance policy toward internal corruption and waste.
And Pony Ma himself is pretty blunt about it.
He was quoted in 2024 describing the internal corruption as shocking, which prompted a rigorous internal overhaul. That kind of candor and rigor, the willingness to acknowledge deep internal problems and fix them, is exactly what rational investors look for in management.
Okay, now we move into Section 4, the financial trajectory. Using a 10-year view to map the company's history, from the hypergrowth era through the regulatory winter right up to the quality growth era of 2025.
Right.
Let's start with the valuation compression and rebound story. Using the price-to-earnings ratio as our guide, it tells a really dramatic tale of market emotion.
It really does. I mean, look back to 2017, the peak of the hypergrowth era. Tencent's PE ratio was sky high, peaking around 42 times earnings.
Wow. Classic growth stock valuation, where future potential is just aggressively priced in.
Exactly. Then the hammer fell. The regulatory crackdown, the Ant Group IPO collapse, the tech winter. By 2022, the PE ratio had collapsed dramatically to a shocking low of around 14 times.
14 times earnings. That is pricing the company not as a global tech giant with a monopoly moat, but almost as a mature, slow-growth utility stock.
It was brutal, a total emotional re-rating. It reflected maximum fear.
So where are we now in the 2025 trailing 12 months data?
The PE ratio has recovered to approximately 25.2 times. This reflects the market acknowledging the resumption of quality growth and the successful internal efficiency gains we've been talking about.
But here's the critical analytical takeaway, right? 25.2 times still sits significantly below the historical mean of approximately 30 times.
And that is the statistical evidence supporting the report's entire thesis. If the market were simply applying its average historical valuation to the current higher quality earnings, the stock would be trading significantly higher than it is today. That gap is the China risk premium in physical form.
Precisely. And while we see this compression and recovery across all the metrics, price sales, price free cash flow, the most vital financial story that confirms the structural change is the V-shaped margin recovery.
This is the aha moment. This is where the theory becomes fact.
Okay, let's take our time here. Walk us through that gross margin trajectory.
In 2016, gross margin was a very high 56%. This is what happens when you sell high-margin virtual goods and run a social network. But over the next few years, it compressed steadily, reaching a low of 43% in 2022.
That's a massive drop, 13 percentage points in profitability. Why did a company with such immense structural pricing power see its margins erode like that? Was it regulatory pressure?
No, it was strategic sacrifice and investment. That period was characterized by massive intentional capital deployment into lower margin infrastructure. They were aggressively expanding the Tencent cloud business by taking on those low margin, customized, subsidized cloud projects just to build market share against Alibaba. They were also scaling up fintech payments infrastructure, which necessarily carries high transaction and bank fees. They were investing for scale and future market dominance, but it came at the expense of current profitability.
So they willingly sacrificed margin to build the infrastructure of the future. The rebound, therefore, confirms that the investment phase is over and the monetization phase has begun.
Absolutely. The sharp rebound from 43% in 2022 back up to a stellar 56% in 2025 confirms the unqualified success of the high-quality growth strategy.
Driven by
the two factors we pinpointed earlier, the rationalization of the cloud business, so exiting those subsidized contracts, and the aggressive scaling of high-margin video accounts advertising. They shed the low-quality weight, and now the core business profitability is returning to its peak pre-investment levels.
Let's turn to the balance sheet and returns, which speak to financial durability. What does their balance sheet fortress look like in late 2025?
It is an absolute fortress. Total assets stand at 2.013 trillion RMB, having quintupled over the decade. And despite that growth, their leverage has remained conservative. They hold a massive war chest. Total cash at 493.3 billion RMB, and crucially, their net cash position, so cash minus interest-bearing debt, is a strong 102.4 billion.
That provides tremendous strategic flexibility.
It does. It's funding the massive buyback program and the critical AI infrastructure investment.
And what about the return on equity, or ROE? That is the ultimate measure of management's efficiency in using shareholder capital.
Well, the ROE story mirrors the V-shaped recovery. It dipped temporarily in 22 and 23 due to asset write-downs during the tech winter and high uncertainty. But 2025 sees a strong recovery into the highly desirable 20.6% range.
And for a mega-cap tech company of this scale, an ROE consistently above 20% is the gold standard.
It is. It indicates that the company efficiently compounds retained earnings, turning profits into future growth very effectively.
Okay, we've established the financials are robust, the pivot is complete, the balance sheet is a rock. Now for the truly rigorous test. Section 5, applying the Warren Buffett standard.
This is what separates mere profitable companies from durable, wonderful businesses that you want to own for decades.
That's the red approach. Buffett famously seeks wonderful businesses at fair prices. Let's structure our analysis around his 4 core investment tenets.
Let's do it.
Tenet 1, the business tenet. Is the business simple and understandable, and does it possess a durable economic moat?
Pass S. I mean, while Tencent is sprawling across games, social media, finance, and cloud, its core function is elegantly simple. Connect people, entertain them, and facilitate commerce. It is a toll road operator for the Chinese digital economy.
And the moat.
The enduring 1.4 billion user network effect is the moat. And the return of high gross margins, now back at 56%, confirms structural pricing power. If your margins are high and rising, you dictate terms, not the market.
Okay. Tenet 2, the management tenet. Are they rational and honest?
Pass. This is where Martin Lau's leadership really shines. The management team has exhibited classic owner-operator rationality by prioritizing value return over empire building. They are not chasing shiny objects.
Right, they're buying back their own stock.
They're aggressively buying back undervalued equity and using those clever special dividends to return value efficiently while navigating political headwinds. That capital allocation discipline, coupled with a zero-tolerance policy for internal fraud, demonstrates both rationality and honesty.
Tenet 3, the financial tenet. Does it have high return on equity and excellent profit margins?
Pass S. I mean, the consistent 20% ROE and 56% gross margin speak for themselves. But the true financial measure, in Buffett's view, isn't just reported net income.
Right, it's owner earnings.
It's owner earnings. The actual cash the owner could theoretically pull out of the business each year without harming its ability to maintain its competitive position.
Okay, let's slow down and clearly define that for our listener. Why does Buffett prefer owner earnings over the reported net income figure?
Because reported net income can be misleading, especially for tech companies. It includes a non-cash expense called depreciation and amortization, or D&A.
Right.
D&A is an accounting charge that lowers reported profit, but it often significantly overstates the actual cash needed to maintain the business, what we call maintenance capex. Buffett wants to cut through the accounting fog and know what is the true free cash flow available to me, the owner, after paying only for the basic upkeep.
So the formula is net income plus D&A minus maintenance capex. You need to use the 2025 TTM estimates from the report to run this crucial calculation.
Let's do it. Let's start with the estimates. The 2025 non-IFRS net income is approximately 225 billion RMB. We then add back D&A, which is estimated at 60 billion RMB, primarily from the depreciation of servers and software.
Okay.
Now comes the critical, non-obvious step,
It is.
separating growth spending from maintenance spending.
The report notes that total capital expenditure for 2025 is estimated around 80 to 90 billion RMB, driven heavily by AI GPU purchases. Is that maintenance?
No, absolutely not. That spending on cutting-edge NVIDIA H100s for training the Hunyuan AI model is pure growth capex. That's a strategic investment in widening the future competitive moat. It's not just replacing worn-out servers.
So what's the maintenance number?
The analysts conservatively estimate that only about 40% of the total capex, or 36 billion RMB, is required for basic maintenance. The cost to replace existing, aging infrastructure and just keep the lights on.
If we run those adjusted numbers, 225 billion net income plus 60 billion D&A minus 36 billion maintenance capex, that calculation confirms just immense cash-generating power, something like $35 billion in annual owner earnings.
It fundamentally confirms the thesis. The key insight for you, the learner, is this. Tencent is generating cash flow that significantly exceeds its reported accounting profits when you properly adjust for the fact that most of its massive capital spending is directed toward growing the competitive advantage, not just maintaining the status quo.
The hallmark of a powerful, long-term compounding machine. Which naturally leads us to tenet 4, the market tenet. Is this wonderful business available at a fair price? Or, ideally, a discount?
Pass. The conclusion is that trading at roughly 19 times forward earnings, considering the double-digit growth, the consistent 20% ROE, and the monopoly-like position, constitutes a fair price for a wonderful business. More importantly, the valuation analysis we're about to dive into shows it's trading at a significant discount to its intrinsic value, implying a healthy margin of safety.
Perfect. That structural and financial analysis sets us up for the ultimate test. Section 6, valuation and margin of safety. How did the analysts quantify the true intrinsic value of this renaissance? They used the discounted cash flow, or DCF, framework.
Right. The DCF is the gold standard for projecting future free cash flows and discounting them back to today, giving us a single intrinsic value number. As you always say, the value of the DCF is entirely dependent on the quality of the assumptions you feed into it.
Exactly. And here, the analysts were deliberately conservative to specifically accommodate that persistent China risk premium. Let's look at 2 of the conservative inputs they used. First, the discount rate, or WACC.
What did they set the WACC at?
They set the weighted average cost of capital, the discount rate, at a high 10%. And this is critical. While the mathematical cost of equity might suggest a lower rate, maybe 8.3% based purely on market data, the 10% rate is deliberately used as an explicit buffer for China-specific regulatory and geopolitical risks.
So they're applying a higher hurdle rate than normal.
They are. The business has to generate significantly higher returns just to justify the price, which builds in an extra layer of safety. They're essentially injecting the China risk premium directly into the model's cost of capital to make the result more conservative.
Okay, what about the terminal growth rate? What did they assume for growth in perpetuity?
They set it at a modest 3%. This is aligned conservatively with long-term Chinese GDP expectations and assumes no aggressive hypergrowth forever. It anchors the valuation firmly in reality.
Okay, let's walk through the 3 scenarios presented in the report, moving from the most conservative view to the most optimistic.
The conservative scenario assumes a very modest 8% revenue CAGR, or compound annual growth rate, over the next 5 years, and some margin compression. Even under these pessimistic assumptions, the intrinsic value is calculated at 525 Hong Kong dollars per share.
And if you apply the required 25% margin of safety?
The calculated buy price is 394 Hong Kong dollars. So even if the economy slows dramatically and growth disappoints, the current market price of roughly 610 suggests the risk of permanent capital loss is relatively contained.
Precisely. Not for the crucial nominal or base case.
This assumes a more realistic 12% revenue CAGR, a healthy expectation fueled by the success of international games and the monetization of AI advertising, and a steady-state 30% free cash flow margin profile.
And under those nominal inputs, the calculation yields an intrinsic value of HPD 790 per share.
790. That is a substantial price target relative to the current market price of 610. That's where the opportunity lies.
It is.
What about the ultimate potential, the optimistic scenario?
The optimistic scenario assumes a 15% revenue CAGR driven by aggressive AI margin expansion, faster global gaming dominance, and continued operational excellence, resulting in a 35% FCF margin. This bullish scenario results in an intrinsic value of $1,150.
Okay, let's hone in on the base case conclusion. With the stock trading at 610, it is trading at a significant discount to that base case intrinsic value of 790.
It is trading at a substantial 22% discount to the nominal intrinsic value. This means the market is giving you, the investor, a significant built-in margin of safety already.
And if you apply the rigorous 25% margin of safety to that 790 base case,
The resulting buy price is 592 Hong Kong dollars.
which means the current market price of 610 is essentially trading right at the buy price, inclusive of a 25% safety margin. It's priced as a safe entry point.
That is the ultimate conclusion of the report. The downside risk is limited, barring a catastrophic, unpredictable regulatory event. The upside potential to 790 or even 1150 if the AI hypothesis proves overly successful is significant. The market is giving you a high-quality asset at a discounted valuation due to external risk factors that may already be fully priced in.
And that brings us to the end of our deep dive into the Tencent renaissance. Let's bring it all back to the learner and summarize the essence of this story.
The essence is that Tencent has successfully navigated the valley of tears, the regulatory crackdowns and the economic slowdown of the early 2020s, and it's emerged as a strategically focused, highly efficient enterprise. They are no longer growing by brute force or chasing low-quality revenue. They are growing with discipline and quality.
The thesis is justified by those three core pillars that now define the business: the widening moat of Wexen, the insulated accelerated growth vector from international gaming, and the margin-expanding technology provided by the Hunyuan AI model powering advertising. This combination fundamentally validates the valuation thesis presented in the report.
And for the long-term investor seeking value, this is indeed a rare opportunity. The report concludes that you are acquiring a monopoly-tier asset, a digital utility company with unparalleled network effects at a utility-tier valuation.
And the aggressive, highly rational share buybacks act as a powerful catalyst.
They do. They're constantly retiring equity and forcing the market to close that valuation gap. They're using their cash to enhance your position as an owner without you having to lift a finger.
Okay, before we go, just a quick disclaimer. All the analysis we've discussed is based on publicly available sources and may be subject to revisions or differing interpretations. This content is for educational purposes only and does not constitute investment advice. Please conduct your own due diligence before making any investment decisions.
And if you found this topic interesting and want to listen to our full deep dive or access even more advanced content, welcome to join our Deep Value Club membership. And don't forget to subscribe to us on Apple or Spotify podcasts. The channel is Deep Value Investing.
And here's a final provocative thought for you to mull over as you consider the long-term durability of this titan. We noted that the source material points out that Tencent's total assets have quintupled over the decade, while the company has remained conservatively leveraged, maintaining that fortress balance sheet. This suggests tremendous compounding capacity fueled by that 20% ROE.
They have demonstrated high returns and enormous owner earnings generation, and the management is dedicating a massive portion of that free cash flow to buybacks, which drives near-term value.
But the other key use of cash is funding that aggressive growth CapEx, the purchase of cutting-edge AI infrastructure, which is the necessary fuel for the next phase of tech development. If the company continues its strategy of investing heavily in AI infrastructure, continually widening the technological gap against its competitors, how wide might that moat eventually become in the global tech landscape? What stands out to you as the most durable, compounding part of their business model?
Thank you for joining us for this rigorous exploration.
We'll catch you next time for the next deep dive.